Hey everyone! Today we're diving into something essential for any business or investor, the 4 basic financial statements. These statements are like a report card for a business. They tell us if the company is making money, where it's spending it, and how stable it is financially. We'll go over each statement, with examples and some common questions to help make it all super clear. Let's get started. First up is the income statement, also known as the profit and loss statement. This one shows a company's profitability over a period of time, like a month, a quarter, or a year. Think of it like a movie of the company's performance. The income statement shows us how much the company made in revenue, what it spent on expenses, and what's left over, called net income. Here's the basic formula: revenues minus expenses equals net income. Let's say we have a small coffee shop. This coffee shop makes $10,000 in sales in 1 month, but it spends $6,000 on things like rent, coffee beans, and wages. So, $10,000 minus $6,000 equals $4,000. That $4,000 is our net income for the month, our profit. The income statement gives investors an idea of whether the business is making or losing money. One question people often ask is, why might a company show a profit on its income statement but still have cash flow problems? Well, that's because of things like credit sales or non-cash expenses. Just because we have profits doesn't mean cash is in hand. We'll get more into this in the cash flow statement. Next, we have the balance sheet. This one is a snapshot of a company's financial position at a single point in time. While the income statement is like a movie, the balance sheet is more like a photograph. The balance sheet shows what the company owns, assets, what it owes, liabilities, and the difference, equity. The key formula here is, assets equals liabilities plus shareholders' equity. Using our coffee shop example, let's say they own $5,000 worth of coffee machines and $1,000 in coffee beans and supplies. These are their assets. But, they owe $2,000 in rent, that's a liability. The difference, which is $4,000, represents the owner's equity in the business. So, $6,000 in assets equals $2,000 in liabilities plus $4,000 in equity. Everything balances. One common question is, why do assets have to equal liabilities plus equity? This is because of double entry accounting. Every dollar that comes into the business is either owed to someone or owned by the business owner. This balance gives us insight into how well a company manages its debt and assets. Now, let's talk about the cash flow statement. This one tracks all the actual cash going in and out of the business, divided into 3 sections: operating, investing, and financing activities. The cash flow statement is unique because it only deals with actual cash transactions, no non-cash items like depreciation. This is key for understanding liquidity, or how easily a company can meet its short-term obligations. Our coffee shop might have $4,000 in net income, but if they decide to buy a new coffee machine for $3,000, that's a big cash outflow under investing activities. So, while the income statement shows $4,000 in profits, the cash flow statement shows that a chunk of that cash has been spent. Total cash flow could end up being much lower than net income, depending on these activities. A common question here is, why can companies show profits on the income statement but still run into cash flow issues? This happens when a business has a lot of credit sales or high non-cash expenses. So, even if a company is technically profitable, it might struggle to pay its bills if cash isn't actually coming in. Our last statement is the statement of changes in equity. This one explains how equity, or the owner's stake in the business, changes over time. This statement shows how profits, losses, dividends, and additional investments affect the owner's equity. It's crucial for investors because it shows how much of the company's profit is being reinvested back into the business versus paid out to shareholders. If our coffee shop makes $4,000 in profit, the owner could decide to reinvest all of it to grow the business. This would increase retained earnings, which is part of equity. If they choose to pay out $1,000 in dividends, only $3,000 would go back into the business, showing up as a lower increase in equity. A common question is, why would a company choose not to pay dividends to shareholders? Sometimes, companies see more value in reinvesting profits to grow the business rather than paying out dividends. This reinvestment could lead to higher future profits, which can ultimately benefit shareholders more in the long run. Alright, so to quickly summarize, the income statement shows profitability over a period. The balance sheet gives a snapshot of assets, liabilities, and equity at a single point in time. The cash flow statement tracks actual cash inflows and outflows. The statement of changes in equity explains how equity changes with